So what's the worst thing which can happen to an e-commerce business owner? We spoke to someone who actually lost their house because they didn't understand their business structure and how it impacted their taxes. In this video, I want to give you absolute clarity on how a business structure impacts your taxes, what taxes they are, when you need to pay it, so you can understand your deadlines and focus on growing your business. So let's go through some of the structures. So you've got two. You've got limited company and you've got sole trader. So a limited company has limited liability. That means you as the director and shareholder are separate to the business. So if anything goes wrong, maybe there's a debt you can't pay, those debts die with the limited company and they can't go after your assets. Now, if you're a sole trader, you have unlimited liability. You're not separate to the business. So if you can't pay a VAT bill or maybe you've got a debt you can't pay, then they can come after your assets. And ultimately you might have to sell, your car, or even your house. So there are times when you can use a sole trader, and it's normally right at the start when you don't have a VAT registration and you're just testing out the market. But I would suggest moving to that limited company as soon as you start getting involved with VAT bills or larger tax bills. So let's look at the taxes which apply to each business structure. So the first one is corporation tax. Now this applies to limited companies and it's 19% and it increases to 25% if you're over 250k turnover. If you're between 50k and 250k, you pay a stepped rate. So for example, if you had 150k profit, you'd pay 24% in corporation tax. So each year you'll have to submit accounts and a corporation tax return. Your accounts go to Companies House and your corporation tax goes to HMRC. You've got 9 months from the end of the year to submit that to Companies House and HMRC. So for corporation tax, you've got a different tax year than you would have if you're a sole trader. So as a sole trader, your tax year runs from the 6th of April to the 5th of April every year. And it's the same for everyone who is doing self-assessment. For a limited company, your tax is based on when you created the company. So we've got an example here and we found a company on Companies House and you can see they're incorporated on February 2024. That means their tax year runs up to February 2025. They've then got 9 months to then file their Companies House accounts and tax return of HMRC. That takes them to the 30th of November 2025. They would then have to pay their corporation tax on the 1st of December 2025. So if you miss these deadlines, you will be fined. So it's really important you put these dates into your calendar. So when you've created the company, look on Companies House, see when your next accounting period ends, know when the taxes are due, and put those dates into your calendar now so you can just focus on growing your business. A good rule of thumb is doing your accounts 3 months before that due date hits, just because it gives you time to review it and then you're not submitting it too early either. So that means if you create a company, you've got 21 months before you even need to consider submitting accounts and filing a corporation tax return. So you've got plenty of time to focus on your business. So then you've got self-assessment, and this is how a sole trader is taxed. So if you're a sole trader, you're going to be filing your taxes on your self-assessment. Now, if you're operating under your own name or you just haven't set up a limited company, you're going to default to being a sole trader. Unlike limited companies, you've got a set tax year, and that's the 6th of April to the 5th of April every year. You've then got until the 31st of January to then file your self-assessment and pay for it. So if you're a sole trader and you've not registered for self-assessment yet, you need to do that before the 5th of October so you can get your UTR in time to file on the 31st of January. So the way the tax works for a sole trader is that you'll just add your income in from your e-commerce business on top of any other income you have. So if you're paying 40%, you'll likely pay 40%. But if you're in 20% bracket, it might push you up to the 40% bracket and you might have to pay a little bit more. So one thing a sole trader can do, which a limited company can't do, is use something called sideways tax relief. And that's if you made a loss on your e-commerce business, let's say 10K, and then you've got employment income of 60K. You can take that 10K and offset it against your employment income. So then you're only taxed on the 50K, and on the self-assessment, you'll actually get a 4K rebate. So the next tax you need to worry about is VAT. And this is relevant for sole trader and limited company. I'm not going to go into VAT in depth. I'm just going to tell you when you need to start worrying about this. So the key thing is you do not need to register for VAT from day one. You've got 90K of UK sales before you need to register for VAT. So if you're selling somewhere like Amazon US on FBA, then these sales don't count towards your threshold because they're not UK sales. So it's only UK sales which count towards that threshold. So what you need to do is monitor your UK sales and track when in a 12-month period they go over 90K, and then you need to register for VAT. So there's one key point about VAT and pricing. So you're not going to register for VAT from day one. But what I want you to do is pretend to be VAT registered. And I don't mean literally by telling people you're VAT registered or putting it on your website. When you come up with your pricing, you want to make sure that your pricing holds up when you're VAT registered or not VAT registered. So when you do get to the point of being VAT registered, it's not a shock and your business survives. This is because when you're VAT registered, your margins are eroded by around 10%. So if you have a product which has got an 8% margin, it's not going to survive a VAT registration. So you need to make sure you calculate that before and you're always aware of VAT. Now, we've done a video on this and it goes in depth on how to do all the calculations. So make sure to check that out. So the number one mistake I see businesses make is they register for VAT way too early. Some register from day one. Don't do that. You've got £90,000 of UK sales before you need to register for VAT. What you need to do with VAT from day one is just use that when you're coming up with your pricing. So from the outset, you've got your prices right and you've calculated them for if you're VAT registered and not VAT registered. That means you can easily scale once you do hit that VAT threshold. As long as you do all that, you don't have to think about VAT until you actually hit the threshold because you've already thought about the pricing and you won't have to change prices when you actually have to register. So understanding your business structure and your taxes is key. And if you get it wrong, there are devastating consequences. We spoke to someone who was a sole trader, but the problem is they didn't register for VAT in time. And HMRC actually sent the letter saying, look, we know you're selling online. You need to register from the 4 years ago and you need to backdate that. So we calculated that for them and it's around 100K they owed, which wasn't much when you split it over 4 years, but in one big hit, it's huge. And the problem is he wasn't selling anymore. And that means he didn't have the income to pay. So he said to HMRC, I can't pay. They said, go on a payment plan, which is 6 months, and then you can pay over installments, and hopefully you pay it all. The problem is he couldn't meet that deadline. He couldn't even make the 6 month payments because his business had failed. But because he was a sole trader, he had unlimited liability, and his debt stayed with him even after he closed the business. So in the end, he actually had to sell his house to pay HMRC. And that's how big of an impact it can have on your life if you get this wrong. And that's why it's really important to understand your business structure and how it impacts your taxes, but also your liability. If you're under the VAT threshold, you can actually stay as a sole trader and there's not much risk there. You only have to pay your self-assessment at the end of the year, so make sure you plan for that. If you're about to go over the threshold, this is the point where we'd say you go from sole trader to limited company. That's because when you're VAT registered, you've just got another risk. You've got another thing you might not be able to pay. So you want to make sure you're a limited company and you've got that limited liability. And then do not register for VAT before you hit that threshold. Too many people do this and they just lose margin. So if you're a sole trader and you can't pay a VAT bill, you've got unlimited liability. If you're a limited company and you're registered for VAT, then you've got limited liability. So if you've got all that, you know about VAT, you know when you need to register, you've put the key dates with corporation tax and self-assessment in your calendar. Now you can just focus on building your business. If you want to learn more about pretending to be VAT registered, where you calculate your prices as if you were VAT registered now, we've done a great video on how to calculate this and it goes in depth. So check that video out. Make sure to like and subscribe as we'll be publishing videos with the aim of making sure every e-commerce business owner understands their finances.